Welcome, everyone. Whether you're a BAccSc student grinding through your CTA year or a SAICA candidate prepping for those massive board exams, you are exactly where you need to be. Today, we're doing a high-yield visual review of gross income special inclusions. In this explainer, we're going to decode the notoriously tricky paragraphs A through F of the Income Tax Act. We're breaking down all that complex legislation into clear, digestible pieces so you can confidently compare your tax exams without getting completely lost in the legal jargon.
So here's our roadmap for this explainer. First, the foundation, then life events, working life, golden handcuffs, and finally, the end of the line. Let's get straight into it.
Part 1. The foundation. Let's decode what these special inclusions are actually all about.
Okay, so picture this. The general rule in tax is that receipts of a capital nature, they're usually safe, excluded from gross income. But these special inclusions we're unpacking today, they're like powerful, deliberate exceptions to that rule. Even if you've got an amount that is 100% undeniably capital in nature, like, say, compensation for losing a right, if it falls under one of these specific paragraphs, bam, the legislation forcefully yanks it right back into the gross income tax net.
Moving right along to Part 2, life events. We're specifically focusing on annuities and alimony here.
Now, paragraph A ropes annuities into your gross income, but here's the funny thing. The Act doesn't actually tell us what an annuity is. For that, we got to look at case law, specifically the KBI and Under v. Hogan case. This case hands us a super practical 4-part checklist to spot an annuity a mile away in your exams. 1, it's got to be an annual payment. 2, it's repetitive. 3, it's chargeable against the person. And 4, listen closely because examiners love to trap you here. It is absolutely not a capital debt settled in installments. If you sell a house and the buyer pays you off every month, not an annuity. That's just paying off a debt. Make sure you don't fall for that one.
All right, how about some good news? A highly testable exception that rewards you for catching that annuity. While paragraph A includes the full purchased annuity, section 10A sub 2 swoops in with some relief. It says the capital portion of purchased annuities is exempt, but catch this, it's only for natural persons. You, your spouse, a qualifying trust, sure. But please, whatever you do, do not apply this exemption to companies when you're doing your calculations. No way.
Now let's talk about paragraph B. This one deals with a very specific, often messy life event: divorce and separation. We're talking about alimony, allowances, or maintenance payments that happen after a formal judicial order or a written separation agreement.
You know, examiners absolutely love testing the dual-sided nature of alimony. Let's break down this classic exam trap by looking at both sides of the coin. For the paying spouse, it's a tough break. They get zero tax deduction for making that payment. But for the receiving spouse, the amount gets specifically pulled into their gross income under paragraph B. But wait, plot twist, it then gets totally exempted under section 1011U. So the net tax effect for the receiver is literally zero. But, and this is a big but, structurally, in your exam, you have to show that inclusion first and then the exemption right after to score those full marks. Don't skip steps.
All right, on to section 3, taxing the working life. Let's look at paragraph C, D, and F. Paragraph C is just incredibly broad. I mean, it catches basically any amount earned for services rendered, for employment, or just holding an office. But the real kicker, the thing you've got to keep your eyes peeled for, is that it includes voluntary awards from an employer. Think about it. Even if your boss hands you a bonus purely out of the goodness of their heart with absolutely zero contractual obligation, paragraph C grabs it and pulls it straight into your gross income. No escaping it. I really want us to see how these 3 paragraphs are linked. They're not just random, isolated rules. It's like a giant puzzle. They're just different angles of taxing an employee's life cycle, from day 1 to the finish line. Paragraph C handles the general services during your employment. Paragraph D steps in to catch the money when that employment ends. And paragraph F, that catches amounts when the actual terms of your contract get swapped out or commuted. If you think of them together as the employment bundle, applying them to those crazy complex exam scenarios becomes a whole lot easier.
Let's zoom in on paragraph D for a second. This is the one that catches those end-of-the-road payouts. It triggers on the termination or variation of an office. And yes, that explicitly includes death. It also scoops up payouts from employer-owned insurance policies. And here's the absolutely crucial part. If an employee breaches their contract, or maybe they just leave early, and they get a payout for the unexpired portion of that contract, that cash is squarely caught by paragraph D.
And that brings us perfectly to paragraph F, which is all about the commutation of rights. Commutation is just a fancy way of saying you're substituting your right to one specific benefit for the right to get a different benefit. Now, fun little piece of tax trivia for you, paragraph F was actually written into law way before paragraph D. Because D is so broad nowadays, F isn't usually the primary inclusion you'll use, but you still absolutely need to recognize it when an employee swaps a contractual entitlement for a lump sum.
Moving into Section 4, the golden handcuffs, we're looking at restraint of trade.
Okay, you need to cement this core concept in your brain. A restraint of trade is, fundamentally, a payment not to render services. It's your employer literally paying you to stay out of the market, to not compete with them, and to restrict your freedom to trade for a set amount of time.
This creates what we can call the restraint paradox. Now, under normal tax principles, getting compensated for losing a fundamental right, like your right to freely work and trade, is capital in nature. By all logic, it should escape gross income entirely. But, well, the legislature saw that massive loophole and slammed it shut. So paragraphs CA and CB specifically include these payments in gross income. It is the perfect textbook example of a special inclusion forcefully overriding the capital nature of a receipt.
So what's the actual damage in an exam calculation? For the person receiving the cash, usually a natural person under paragraph CB, that receipt is taxed immediately and in full, right there in their gross income. You don't get to spread it out over the 3 or 4 years of the restraint. Ouch, right? But on the flip side, because the recipient is taking that tax hit, the payer, the employer, gets to claim a specific tax deduction for it under Section 11 CA. Pro tip, always look out for both sides of the transaction if you're tackling an integrated question.
Finally, Section 5, the end of the line. We're talking fund benefits.
Paragraph E has one very specific job, pulling in lump sum benefits from retirement funds. So whether we're talking about a pension fund, a provident fund, or a retirement annuity, if you get a lump sum paid out when you retire or when you withdraw from the fund, paragraph E is the exact mechanism that drags it straight into your gross income.
All right, pause right here and pay super close attention because this trap catches students every single year. Paragraph E does not include the entire gross lump sum in your gross income. No way. It only includes the taxable portion of that lump sum benefit. In your exams, this taxable portion is usually handed to you, or you'll have to calculate it using a separate tax table. If you just take that massive gross payout and dump the whole shebang into your gross income calculation, your entire tax liability for the question will be completely busted.
As we wrap up this explainer, I'm going to leave you with a quick scenario to test your recall. Imagine an employee breaches their contract, right? And they receive a massive payout for the unexpired portion of that contract. Which paragraph catches the tax? Think back to that employment bundle we talked about. Is it general services under C, a restraint under CB, or termination under D? If you said paragraph D, you hit the nail on the head. Absolutely spot on. Keep applying this structured, thematic approach to your studies, and you are going to easily navigate the absolute maze that is gross income. Good luck, and keep studying smart.